Hello. How you doing, guys? Today we're gonna learn about mainly technical analysis. As I put in this module, we have two different types of analyzing in finance, fundamental and technical. But fundamental is more used for stocks, and technical we can use it for either stocks or bonds, okay? But because we haven't started our stocks lessons plans, we are gonna focus on the technical analysis, okay? Well, with that being said, it's still important to compare technical to fundamental analysis. Okay, so here we go. Fundamental analysis, as the name says it, is all about fundamentals. So it's all about economics, accounting, ratios, valuations of things in the market. So the real thing. Think about fundamental as what is happening in a company. If a new CEO gets hired, if they messed up with the accounting, like the Enron case, or if they are having wrong ethical practices, all those type of stuff are fundamental analysis. This analysis assumes that the market is efficient, and that means that everybody has the same information at the same time. Now, we know that this doesn't happen often, but that's what the analysis assumes, okay? Because everybody has the same information and they get it at the same time, then they are able to analyze the stock or the company on equal basis, okay? Now, technical analysis is everything related to past history as far as the price and rates of the asset. And this is why we can only do, well, we use mainly this type of analysis for bonds, okay? Where the fundamental analysis relies all the information in current events or in current practices. Technical analysis will be more concentrated on past history of the price if we are talking about stock, or of the rates if we're talking of bonds. So they're gonna forget about all current situation. They're just gonna focus on past history and stats, okay? They combine the prices or the rates. When we're talking about bonds, we always talk about rates and statistics, okay? They're going to combine those two things. And with those two things, they're going to analyze and trying to predict what is going to happen with the bond. Okay, now I'm going to start talking about bonds here because that's the purpose of this model. This technical theory relies in three important principles. The first one is it assumes that all the rates in past history of the bond, it's a reflection of how the market sees the bond. So it actually makes sense. If the rate has gone up over the past 14 days, well, that means that the price has gone down, and that means that the market does not want or is not demanding that bond as often, okay? So they are relying on past history and they are taking that history as a reflection of the market. The second premise is with that information, this theory assumes that all tendencies can be identified. So with that past history and using statistics, we are able to identify if the bond is going to go up in price or down in price according to XYZ statistics that we choose to use. And the third one is, and it's probably the most debatable one, is that history is going to repeat. So think about it. If we are analyzing past performance, that means that we believe that that past performance somehow is going to relate to the future. Okay? And this is the main difference with fundamental analysis. Fundamental analysis is all about what is going in the future with new events based on current events. And technical analysis, this analysis, is all about what happened in the past, and we assume that that's going to repeat in the future, and that is why we're able to draw or or create tendencies. Okay? Now, what are the main advantages of technical analysis over fundamental? In fundamentals, you need a lot of information. In technical, you just need a small sample size. Okay? I mean, as long as you have the 10 previous days, a month of rates of the bond, a year, and you compute that information, you can draw tendencies. And the most important one is, instead of having different options, because in fundamental everything is subjective and people can go in every single direction, with technical analysis what happens is, when you get the results of those technical statistics, then you can either go up or down. Okay, the statistics gonna tell you how the stock is gonna move either up or down. So it's pretty straightforward. It's in that way is so much better than fundamental analysis. Okay. The disadvantage of technical analysis is that if you really think about it, if we all have the same instruments and same things to calculate with, and we figure out a tendency, and let's say we figure out that the bond is going to go up in price or down in rate, then everybody will be buying the bond, right? Because it is expected to grow. Well, this is impossible, because you always need somebody that sells that bond, right, in order to buy it. So technically, technical analysis cannot be possible because not a lot of people can do the same action with the financial instrument. Okay, if it happens, then the market breaks down and moves in a different direction. Okay, what are the tendencies that we're gonna analyze with technical analysis? Tendencies have direction and duration. Okay, they can either go up or down, they can stay the same, and we're going to analyze tendencies based on the period of time. So we're going to play with time. Okay, we can go back to 50-day averages, to 200-day averages. We can play with time depending on what we want to analyze of the instrument. Okay, this is an example of an upward tendency, and you clearly see the graph going up, and this is for a 4-month period, and you can see each month the instrument, in this case is just a currency, going up. So this is a simple example of upward tendency. Now, the two most important terms in technical analysis are support and resistance. Okay, support is if you draw a line here in between the two lines, you will have the average of this period. So imagine that you have all these different numbers in Excel, and you have an average in between, right in between. Okay, well, the support is going to be that average minus 2 standard deviations. Okay, and that's this line. And the resistance would be the average plus 2 standard deviations, which is the upper line. Okay, why is this important? Because it is thought that an instrument cannot move, or it's very rare to move over 2 standard deviations either way. Okay, so every time an instrument breaks the resistance, like you can see it in here, well, that means that the instrument has gone up too much, and chances are that it's gonna go down again. Now, when it breaks the support, happens the other way. It is very rare, so chances are that the instrument or the bond is gonna recover and go back again. Okay, so again, in the middle you have the average up, you have the resistance with 2 standard deviations up, and underneath you have the support with 2 standard deviations down. Okay, now in the presentation I added the formulas that you can use. Okay, So it's important to go to the notes in the presentation and see how they're simple, very simple calculations, but it's important for you to be aware on how to calculate these things. What about the bar graph? Because we see a lot of this and sometimes we don't understand what is going on. Okay, we know that the points are different points of the instrument, of the financial instrument over time. But the graph has two characteristics that are important. Whenever you see a red line, that means that the instrument finished on a downward trend. So that means it finished lower than the price at which it opened the day. Okay? And when you see it in a blue line, it means that it finished in an upward trend or higher, in a higher price than at which it opened the day. Okay? Now the horizontal small lines that you see here, it's right exactly where the price started the day, and then all that movement is what happened during the day. Okay, so you can see if you compare the two horizontal lines, it's the opening of the instrument and the closing of the instrument. Okay, so this would be a lower price of a bond and a higher price of a bond. I know this is currencies, but you get the point. Okay, that's how the graphs are computed in finance. A candle graph is the same thing, but just adds a little rectangle that is going to tell us the traded operations, so the actual bought and sold operations, and it's going to add these little lines that you see here that refer to offers but not trading operations, which means somebody, let's go to this example, somebody could have put an offer of buying this instrument over here, but it was never bought and sold here. So there was never a transaction in here. But the offer is important because it tells you how the market is going and how the market is trying to buy and sell the bond or any other asset, okay? So again, this is the same thing. You have blue and red candles. It's just adding if the instrument had other offers that were not traded, but they are important because they show specific trends, okay? Or they can relate to specific trends of the instrument. All right, the symmetric triangle, it's important because I'm not going to go very deep into this triangle because it's very rare, and I will post a link going more in depth about this. But this is used for companies that are growing or going down every X amount of time. Okay, so you will see an stagnation time like in here, and then an aggressive upward movement of the price. Okay, so I'm gonna give you an example of this. This is what happens when maybe the Apple company release a new iPhone. Okay, so they are operating here, and once they release it, the stock gets favored, right? The market likes the release of the new product and they demand, so the price goes up and then stops and kind of stables itself again. Okay, so every time a company has important events, you can draw these triangles, and again you will see the formula in the presentation, and I will post a link that goes more in detail about this triangle. The important thing about the triangle is that if you see this part of the graph, this is like the stable part, okay? And this breakout is when the company releases some other product or releases new information and it's seen as positive, okay? So that's how the volume picks up, okay? This blue lines that you can see here are the volume traded, and that relates to whenever the price goes up aggressively, okay? That will be known as the triangle breakout, and that's when the stock or the bond price goes up aggressively, okay? Bollinger Bands, what are these? These are related to support and resistance, okay? But they're gonna deal with moving averages, I'm going to post a quick explanation of moving average in Excel, okay? But just know that the moving average uses the most current information. So imagine you have 10 pieces of data. You can have an average of that. Well, then you add the next day, you will have an 11 data, right? What the moving average does is eliminates the first one and takes the most recent one. So you will always have 10 points of data, but only the most recent ones. You can have moving averages of 50, 12, 200, whatever number of days, but just remember that this moving average eliminates the past and goes more deeply into what is going on currently. And that is how Bollinger Bands are created. This middle line is the moving average. Most of the times we use 14 days, and we have again 2 standard deviations up and 2 standard deviations down, okay? So this is a more, Bollinger Bands are more used for analyzing recent and current information of bonds. This is a very interesting one. The RSI index, which stands for Relative Strength Index. So this is very important because relates to the volume traded and the number of days the bond has been up or down in price. Okay? Again, we use 2 weeks, sometimes 3 weeks to compute this type of technical analysis. And what it does in here, I want you to pay attention to the bottom part of this graph. You have a 50 in the middle and you have an 80 and a 20 at the top and at the bottom, okay? So what this does is it's gonna count how many days the bond has finished up in price, okay? So every time it finishes up, it starts going up and up and up and up, okay? If one day of, let's say 10 days, the bond prices goes down, then it goes, this strength index recovers and goes down again, okay? So it will only count the consecutive days that the bond price has been going up, okay? Same to the other side of the graph. It's gonna count how many days the price has finished down, and if at any point it doesn't finish down, then it will recover and go back, okay? Now, why is this important? Whenever you pass this line, this 70 line, that means that 7 consecutive days, if we are dealing with a 14-day index, 7 consecutive days, the price of the bond has been going up and up and up and up, which means you have to watch that day because chances are that it will go back again. It will move back to the average. The opposite is the same, okay? Whenever it crosses the 30 line, that means that 7 consecutive days, again dealing with a 14-day index, the price is going down and down and down consecutively. The part that is consecutive is very important, okay? So that chances are that the price is going to go up and recover again, okay? Or something is happening. Something important is happening, okay? So if you see this, the price went up. We have a relative strength index of over 70 when the price was going up and up and up and up. And when the price was going down and down and down, the index went down to 30 and it crossed it, okay? So you have an important question in your activities related to this index. So pay attention to that and think about momentum. This is a momentum analysis. It will teach you how the price is moving consecutively in an instrument, okay? Flags. This is similar to triangles, and you see it when, especially when companies are cyclical. Let's think about Christmas companies or maybe what other companies are cyclical? Well, you can think of any other company that has an uptick period in the year where they sell most of their stuff, and that will happen to the stock or the bond. Okay, you have this data that is stable, and then you have an aggressive movement up, or it can be an aggressive movement down too, and that comes when the company is cyclical. Okay, when they have special periods of time where they are more active. Okay, now flags are not important to calculate because now computers do it, but it's important to interpret it correctly. Okay, once you see these flags, then what you can assume is that the next time the company goes into that positive period in the year, they will have an upward tendency, the same size of the pole or the same size of the previous movement. That's what it's important. Again, technical analysis uses a lot of stats, okay, and I want you to do some extra research on this. It's not an activity, but that's just for you. I will post an explanation of moving average, but try to research more into exponential moving averages, Bollinger Bands, RSI, and Elliott waves, okay? Now, I'm gonna give a 3 extra point bonus to the people that deliver in my email some type of research about Elliott waves. I don't want a long research. I just want you to understand what are they, and maybe post a question what you find interesting, and maybe how can we apply this to bonds. Okay, so I'll give 3 extra points to the people I'll deliver that. Okay. All right, people. See you soon, and start getting ready for your exam, okay? Thank you.